Good afternoon, I'm Zach Ryan and I work in the investment management team, and I'm going to give you a brief overview of this week's market summary. Early in the week, sterling versus the US dollar fell below 1.2 for the first time since January 2017, which helped lift the FTSE 100. As we've highlighted before, the majority of FTSE 100 companies generate their revenue overseas and so benefit from sterling weakness. As the week progressed, sterling somewhat recovered as the Conservative Party lost their majority in the House of Commons and opposition parties progressed their efforts to block a hard Brexit. While sterling's recovery weighed on international earners, domestically orientated companies gained with the exception of utility companies. With the general election looking increasingly likely in the UK, the prospect of a Labour government weighed on utility company share prices, as Jeremy Corbyn has previously expressed his desire to nationalise them. The UK PMI readings for August missed analyst estimates, with manufacturing PMI in particular coming in at 47.4, its lowest reading in 7 years. Finally, in the UK, the FTSE 100 quarterly review took place this week and resulted in Marks & Spencer being ejected from the index for the first time in the index's 35-year history. In the US, additional tariffs on Chinese imported goods came into force this week. Whilst it will be a while before their impact feeds through to data, the Fed's Beige Book highlighted that companies are concerned about tariffs and trade policy uncertainty, but generally they reported minimal impact so far. The US ISM manufacturing fell to 49.1 from 51.3, whilst non-manufacturing beat expectations coming in at 56.4 versus forecasts of 54. The survey respondents remained concerned about tariffs and geopolitical uncertainty. However, they were mostly positive about business conditions. US non-farm payrolls also fell short of the mark, with 130,000 new jobs created in August, which was 30,000 lower than forecast. Average hourly earnings came in marginally ahead, growing 3.2% year-on-year versus the expected 3%. But despite this, the overall disappointing US data helps bolster the case for the Fed to cut interest rates at the 17th-18th September meeting. Over in China, a report to Chinese Congress by an internal commission concluded that the 14-month trade dispute between China and the US has had little direct impact on the Chinese economy. They also stressed that China's cyclical economic downturn has been driven almost entirely by domestic factors. Whilst trade may not be weighing on the Chinese economy, talks were back on the cards as it was reported this week that officials from Beijing are expected to visit Washington in early October for talks. Elsewhere in China, Hong Kong withdrew the controversial extradition bill. This provided investors some relief as protests have been having a notable impact on the region. Finally, China's central bank cut the required reserve ratio by 0.5%, and the reserve ratio for some city commercial banks by 1%. This provides additional support for the economy, such as lowering funding costs for the manufacturing sector. Now that's all from me this week, and don't forget, if you haven't already, you can also read a more detailed insight into matters affecting the markets in the email.